Welcome investors to Joe's Investment Express. Today I want to do a deep dive on Golden Ocean Group Limited, a dry bulk shipping company. I'm really excited about this stock right now, and I want to explain why technically and fundamentally. And I also want to use this as a chance, as a springboard to show you my research process, how I go about researching a stock. I do it really fast and as efficiently as possible. And so let me show you how I do that, and maybe you might want to adopt some of those practices. And I'll tell you what I don't do. What I don't do is get on YouTube and find a bunch of YouTubers telling me why the stock is such an amazing stock. And I don't get on financial websites and look for articles saying why this stock is a must buy. That's just confirming biases, in my opinion. What I want to do is go to the primary sources, the transcripts, and look at the numbers and make my own opinions. Now, the last step, which I'm not going to show you today, if I was going to do a long-term hold, like a 5 or 10 year hold, then I really want to get to know the CEO, because over a 5 to 10 year time span, it's the CEO that is going to it's the jockey ultimately. And so, with Tesla, when I held it for multiple years, and with Nvidia, then I did get on YouTube and watched a bunch of interviews and presentations of the CEO. But I'm not going to do that with this stock, because this is probably a 1.5 year hold at the max. So let's get started. Let's look at the technical chart. Then let's look at the fundamentals via MarketSmith. Then I'll show you the website, and we'll look at the latest conference call. We'll see how long this takes. Hopefully not too long, because I got things to do today. So do you. So the shippers, it's interesting. About half of them are doing great, and half of them are just wallowing, moving sideways. It's definitely haves and have-nots, and some of them are navigating the supply crunch and COVID crisis expertly, and some of them, I guess, are failing to do so. But if you look at GOGL, Golden Ocean Group Limited, this is a fantastic chart. You've got a strong prior uptrend from 3 to 9. That's quite an uptrend. Boy, don't you wish we were buying this thing in 2021? I wish I had known about it then. So you have this strong prior uptrend, and then you got this nice shallow double bottom base. This is the atom and atom double bottom base, and you got a couple wicked shakeouts. This shook out. There was some supply here, probably got shaken out here, as well as this supply. You got another shakeout here. Most of this supply got shaken out. You got another wicked shakeout. These shakeouts are really good. That shakes out the weak hands, and eventually there's nothing but long-term holders in here. Then with the least bit of good news, up it goes, right? Let's check and see how deep this base is. Let's see, annotate my chart. Do this little, if you have a charting program where you can do a percentage tool, it's really helpful. This is stockcharts.com, but there's a bunch of different ones. So the base, that's not really, let me try again, hold on. Okay, I'm going to call the top of this double bottom 9.25, which means it went down about 29%. And ideally you want it to see less than 25%, but in a bear market, 30 or even 35% is acceptable. What you don't want to see is a deep, narrow trough. Those just are more prone to failure and more prone to profit taking as soon as they break out. They will work sometimes, but you have a much better chance of success if you see a shallow base, especially a multi. Look, this is 1, 2, 3, 4, 5, 6, 7 month cup. That's a long time for people to get shaken out. A lot of people buy out of a little cup like this 1 or 2 months, and then that was a text from my mom. And then they wonder why it failed. Well, there just hasn't been adequate time for the weak hands to shake out. That's part of it. Especially if it's like a 1 month base, like something like this. Now, obviously this worked, but you really don't want to be buying a breakout off of that. I'm getting into a rabbit hole here, but that's not the purpose of this video. Okay, so we had a great breakout. We had a 31% uptrend with no pullback. The fact that it broke out of its cup here and did not pull back, that's a really strong sign. And then we had earnings come out here, and look how positively there's been virtually no profit taking after earnings, and now it's setting up. This is your proverbial high tight base, and look at this volume calming down. This thing is calming down. Now what we want to see happen is for it to calm down here like it was in mid-August and then break out. I'd love to see it oscillate a little more, maybe come down one more time and touch 11.25 or something, and then break out. But if it goes, I'm going to be buying it on Monday. A breakout on 12.05, I'll buy some, and then if it finishes the day strong, I'll buy some more. We might see an intraday squat like this, so we got to be careful and not rush in on a full position when it clears this support. Now let me show you the 10-year chart, and this is so typical, or maybe the 20-year chart. This is so typical of shippers. Shipping companies are not buy and hold forever stocks. They have boom and bust cycles, and you ride them for a year or two at the most, and then you get the heck out of there. And so right now we are very much in a boom cycle. But if you put this chart up next to Apple or Microsoft or Google or Costco, and you'll see what I mean about what a long-term hold is and what a long-term hold isn't. But I'm going to show you in a minute. This stock, in theory, should do really well for the rest of 2022 and hopefully through 2023. That's what I am banking on. All right, so let's get to so the first thing I do is I identify a stock based on its chart. This chart looks great. Now, if I'm just going to do a little swing trade for a few days, I don't even do any fundamental analysis. The only thing I do is check and see where when earnings are coming out and make sure I'm not buying right in front of earnings. I know a lot of people love to buy in front of earnings because they want to get that big jump up. But I'm afraid of earnings announcements. The worst thing in the world that can happen is a big gap down that misses your stop. So I always want to make sure that earnings have come out, and in this case they have. But since I'm going to try to hold this, hopefully, like I said, to the end of 2023, then I really want to do some fundamental research. And I didn't decide that until after I did my research. So my next step is I look at just some really basic fundamentals, and I only look at a few things. And I do it through MarketSmith, but there's all sorts of different ways. My brokerage, E-Trade, has fundamental numbers. I mean, you can find them anywhere. MarketSmith just makes it really quick and easy. But this software, or subscription software, I don't know what you call it, costs over $1,000 a year. So that's a lot. However, if you make one trade and make $1,000 on that trade, and you wouldn't have done so without this MarketSmith, then it pays for itself, right? That's what I think. Okay, fundamental research. First, I look at the relative strength. This is the strength of the stock compared to the S&P 500. This is at 98. It's outperforming 98% of stocks. I want to see it at least above 85. So that's great. And it's trending to the upside. And then here's our description. International tanker company, primarily focused on seaborne, northeast transportation of dry bulk cargoes. Market cap, $2,405 million. Okay, so I look at the yearly EPS growth, and it's not amazing. They're making $2.24 in 2022. They actually made more in 2021, 2.73. So that's interesting. But boy, the conference call transcripts reflect a lot more optimism than those numbers. So I don't know what that's all about. That's actually a little disappointing, to be honest. What you want to see is a huge breakout year where you see, well, okay, you know what? There is. 2020, negative 96. 2021, positive 3. So I guess that's our huge breakout year, and that's because of COVID, obviously. And that's true of most of the shippers. But that's what you want to see, a huge jump in yearly earnings. PE ratio is minuscule, 4. The shippers tend to have very small PE ratios. Different industries have different average PEs. That's something you got to be aware of. But we can use that. I don't pay too much attention to that. I know value investors really try to gauge the cheapness and so forth of the company. But honestly, a super low PE ratio is often a concern that the company's not doing well. In this case, I think the shippers are just really, their prices are really, really low in comparison to how much money they're making right now. The yield is 20%, and that is, that's legit. It really is. All of the shippers are paying out huge dividends this year and probably next year, but some years they don't offer any dividends. So it's feast or famine, like I said. And then you want to look at the revenue. Is the revenue sales growth growing dramatically each quarter? And it is triple digits, triple digits, triple digits. And as you know, there was it's pretty easy to go triple digits when they were hardly shipping anything in 2020. Triple digit EPS, that's really outstanding. Incidentally, this shows the other top companies in the group. You might want to screenshot that. I also own Zim, but I've looked at the charts of these other ones. Anyway, don't get me distracted here. So that's about it on the fundamentals. I also like to figure out how much cash on hand the company has. So then my next thing that I do is I just go to the company website, and MarketSmith has a shortcut to the company website, but you can find it. You can just type in the stock symbol and homepage or website, and you'll find it easy enough. And then I just do a little exploring here, and I read about the company, and I go to the investor relations page, and I look at some of the press releases, and I like to find a slideshow presentation. So here's a slideshow presentation that they did with earnings. And so let's see if I can open that up. Yeah, right here. So then you can very quickly just get a feel for some of the company highlights. And here's some of the fundamentals. This is a really interesting chart here. So here's the cash that they had at the beginning of the period, and then here's the cash they made from operations. Here's some more cash that they made, sale of assets. Here's the money they spent on dividends, on capex, repayments, finances, and this is how much cash. So they have a little bit less money than they did when they started out, but they had 262 million in cash. And now they have 210 million, but they gave 170 million in dividends. You can look at the balance sheet. So yeah, there's just interesting stuff to be found in these investment presentations. And this is one of the interesting things as to why I think these shippers are going to do well for the next couple years, because the shipping fleet is not growing. The net fleet growth is the lowest it has been in 30 years. Because of the demand crash in 2020, all of the shipping companies are really, really hesitant to expand, including GOGL. And so demand is greatly outpacing supply. Oh, and that's what this says. Demand to outpace supply through 2023. And I just like to quickly, read these slides quickly and glean what I can. Significant cash flow secured in first half of the year, effectively building a bridge into the second half of the year, which is expected to be much stronger. And industry low cash break even, strong cash flow potential. That certainly sounds good. That's about it. Now you could make a case for looking at this after you read the transcripts, but I like to look at it before. It gives me kind of a preview of what to expect in the transcripts. So then the next thing I do is I go to the company transcripts of the last earnings report, which in this case was mid-February, about a month ago. So I find it through Seeking Alpha. Now you could certainly just Google it and find it easy enough. But this is the quickest way for me to find it. I go to Seeking Alpha, I type in the stock symbol, and then they have analysis and news. I do read some of these news items, but you know what I don't read is the doggone analysis articles. It just confirms my biases. And they almost always say, they're almost always glowingly positive, even when a stock is about to go down. So I just don't find them helpful. I really want to do my own analysis and decide for myself what I think, not hear what someone else thinks, which is ironic because you're listening to me tell you what I think. But ultimately, you need to decide for yourself if this is a strong company. Anyway, you go to Transcripts. Here's all the company transcripts. And here's that presentation. Look at that. So you click on here. Now, there's two ways you can go about this. You can print it out. You can get your highlighter and your red pen, and you can go have a seat in your comfy chair and read this. Spend 30 minutes reading this thing and highlighting and just enjoying the process. And I do that on my long-term holds. For example, when I was holding Tesla for years and Apple and so forth. But if I'm just planning to hold a stock for a few weeks or months, then I just want to burn through here as fast as I can. So I look and see who's speaking, the CEO and the CFO, skip all this stuff, and then you want to read the introductory remarks from the CEO and the CFO pretty carefully, and then you can kind of skim the rest. So in the first opening statement, the CEO usually makes kind of a thesis statement of sorts. If you remember doing essays in high school or college. This cup is obnoxiously big. And so good old Ulrich here said, what we will show you during the next 15 or 20 minutes is that we have capitalized on the strong Q4 while securing attractively priced cover for the first half of this year, that we will continue to pay out a significant portion of our net profit in dividend, that the supply and demand fundamentals remain in place for a sustained period of profitable markets. That sounds really good. Then he says, we recorded an EBITDA just above 240 million, net income of 204 million. This is the best quarterly result in the history of the company. That's impressive, and that should move the price, right? So I'm just skimming through this as fast as I can and looking for things that are important. Here's another interesting tidbit. He says we had cash and liquidity year-end of about 300 million. With the low leverage and young fleet, we have significant access to attractively priced funding for refinancing that come due in the next years, and also the funding of our new building program. This gives us the flexibility to allocate capital freely if they want to buy more ships, etc., and continue our focus on dividends. That sounds good, right? Okay, next he says, Q4 was another good quarter for the dry bulk owners. Cape rates hitting $87,000, I think, per day. $87 per day. That's crazy, isn't it? This is the highest level we've seen in more than 10 years. Even if rates did cool off, the rates were far exceeding cash break-even limits during the entire quarter. So these companies, to be blunt, are making tons and tons of money right now. So, of course, their stocks are going to go up right now. The three main drivers were the continued inefficiencies and congestions, a strong growth in the coal trade, and rising Brazilian iron ore shipments. Now, here's one of the several of the statements that make me think I'm probably going to be holding at least some of this stock through the end of 2023. I'll probably trade around a core position. I'll have a core position, and then I will add more on pullback bounces, and I will sell some when it gets overextended. Here he says, we remain very bullish for what lies ahead. In fact, the stage is set for a prolonged period of solid demand growth for dry bulk commodities all the way through 2023. Not to 2023, but through 2023. Says there are many factors influence demand for dry bulk, but GDP growth has always been one of the best proxies. For the past 20 years, the demand for dry bulk shipping has been growing 20% more than the world GDP growth. So even if GDP growth is tempering off slightly this year, first compared to an exceptionally strong 2021, still growth rates that are high compared to the historic average. In our view, the anticipated growth will support a continued strong freight environment. So demand for dry bulk shippers is going up 20% more than the world GDP growth. So demand is really strong, and supply is really, the supply of boats is really weak. There's a big shortage. It says the order book currently sits at no less than a 30-year low. Going forward, we do not see ordering of new ships picking up because the prices for buying and building new ships are at a historically high level until the end of 2023. It gives us a runway of a minimum of 2 years with very modest fleet growth. So for 2 years, demand should be high. The fleet of ships should be growing very slowly. So there's a balance. What am I trying to say? A big disparity between the demand for these ships and the supply of these ships. Shipping is, of course, cyclic. That's what I've been telling you. But usually the downturn is caused by oversupply. There's demand. The shippers build a bunch of new ships, and then there's too many ships. But because of this low number of ships being built, this up cycle is going to be longer than usual and stronger than usual. Let's see. Yeah, so it says it's normal for the owners to oversupply the market, which causes the freight to come under pressure, not the lack of demand. But this time, the supply side is well under control and ordering has been muted for some time and not looking to pick up. And honestly, this this conference call just keeps getting better and better. Listen to this. The market will be driven by healthy demand growth combined with an exceptionally low fleet growth, which I just said. This is, of course, positive. However, disruptions and congestions in the supply chain, which was a major factor in Cape rates reaching $87,000 per day, are unlikely to unwind anytime soon. So the shippers that are navigating these disruptions effectively are capitalizing. The disruptions and congestions at the ports are actually good for these shippers. These inefficiencies will continue this year and support a strong freight environment. Looking in 2023, there are new regulations on emissions, which will further affect the supply of ships because the new ships will have to have better emissions and they might have to retrofit other ships, etc. Golden Ocean remains confident that the dry bulk market stands in front of a prolonged period of profitable markets. So their cash break-even rate is $12,800 for the Cape ships and $8,600 for Panamaxes. So right now, they're getting, what did we say, $87,000 per day for Capes, and their break-even is only $13,000 per day. So Golden Ocean's cash flow potential right now is, quote, substantial. So here's a little note on the dividend. With no material capital expenditures and no appetite for building new ships, it's a fair assumption that Golden Ocean will continue to have dividends on top of the priority list when it comes to capital allocations, something which certainly so far has been the case, seeing we have paid out $500 million in dividends relating to 2021. And that's what most of these shippers are doing. Instead of building new ships, they are shipping out huge dividends. For example, Zim is doing a $17 a share dividend in the not too distant future. Okay, then you look at the concluding statement. Golden Ocean capitalized on the strong Q4 market, making more than $200 million in net profit, the best quarter in the history of the company. Golden Ocean has built a bridge between the weaker first half of the year and the expected stronger second half of the year by taking out fixed paying contracts. Golden Ocean has paid $500 million in dividends related to 2021, and dividend continues to be a priority 2022. Then you have a Q&A session, and I just skim these and look and see if the question is interesting. If it is, I read the response. If not, I skip it. These are questions and answers with fund managers. This was just a question about the port congestion. He says, we do not expect congestion to unwind this year. We see inefficiencies persisting for this year and next year, and that will help the already strong supply-demand balance. And that's it on that conference call. So as you can see, in about 15 minutes or so, I just burned through the transcript and, look for the future, figure out the future direction of the company. And ideally, I want to see the transcript be very bullish in nature, which this is, and the chart coinciding with that. And I look at the chart first. If the chart's not performing, I don't care what they say in the transcripts, because the CEOs are always going to spin it in the best light. So the chart is the most important thing. So in conclusion, that's how I do research on companies. And let me know your research process. And I am planning to put on a big position in GOGL soon if this high tight base breaks out to the upside. Now, if it pulls back, then I'm definitely not going to be as excited about getting into the stock. And we'll just play it by ear. We'll cross that bridge when we come to it. I'll let you know next week when and if I open up a position in this company. Let me know if you know anything further about GOGL or have any just questions in general. And of course, have a great weekend, everybody. Take care.